everyone, and welcome to Financial Resolutions for 2025. We are so glad, Deborah Hickey and I, to welcome you here to refresh your thoughts around planning and risks for the new year. We can start the slides, I think,
All
Deborah.
right. Hello, everyone. So glad you could join us today. Let's get this working here. There we go.
Perfect. Okay. Our clients realize that building wealth, lasting wealth, takes a holistic approach. The beginning and the end of the year is a very good time to make sure that everything is working together. Changes in regulation and taxation can be particularly important and can impact people with complex financial lives. These changes can occur with regime changes in Washington, D.C., like we saw at the beginning of this year, and with people, these changes can impact and can highlight important gaps in your overall wealth strategy. So if you have any questions during this time, please use the chat feature to enter any questions you might have. And whoever's not speaking will field the questions, or we'll hold off until the end for answering. I'll kick it over to you, Deborah, to start us off.
Okay. Well, our first resolution we're going to cover is updating beneficiaries. Life happens. You know, families, names, and assets are prone to change. And when your accounts were first opened, they were probably accurate then, but how long has it been since you last checked? Take time to review and update your beneficiary designations on retirement plans, your 401ks, IRAs, 403bs, annuities, as well as life insurance policies. Regular reviews are essential, especially when life circumstances change, such as, you get married, divorced, children reach adulthood, or the arrival of children or grandchildren. So ask yourself, do your beneficiaries' designations reflect your current wishes? Are they aligned with your estate plan, including your will and/or trust if applicable? And it's better to check them on occasion than be surprised when you need them to be most accurate. Account titling can have far-reaching consequences affecting a wide range of issues, including your estate plan. So, for instance, account titling often supersedes statements made in the will and may avoid probate. So consider how the account is registered. Is it in your name only, a joint account, or a trust account? For example, if you have a joint account registered as joint tenants with right of survivorship, that account will pass to the survivor upon your death, would not go by way of will, and would avoid probate on first death. Haphazard account titling can create problems down the line. So if one partner dies and an account is titled only in their name, those assets can't be readily accessed by the survivor. So the solution may be creating joint accounts, but it's not always that simple. It's important that the registration on your accounts aligns with your estate plan. Account titling also can affect borrowing power because it determines ownership, liability, and how lenders assess credit worthiness. So for joint accounts, both owners' incomes and credit scores may be considered, potentially increasing borrowing capacity. But a co-owner with poor credit could negatively affect those loan terms. For trust accounts, lenders may not allow borrowing against assets in a trust account, particularly in an irrevocable trust. Then we have tenants in common, where each owner can use their share as collateral independently, whereas with joint tenancy or tenancy by the entirety, borrowing against property may require approval from all owners. So account titling significantly impacts taxes in several ways, including income taxation, estate taxation, and liability for capital gains. Many of these topics we're covering today could really warrant an entire webinar on its own. So for the purpose of today, I'm only going to provide a couple of examples. So individual accounts are obviously quite straightforward. Joint accounts, so we have the joint tenancy with right of survivorship, where each owner is taxed on the portion of income, and at death, the surviving owner may receive a step-up in basis on the deceased portion, entire value, and the entire value may be included in this deceased estate if they provided all the funds. Tenants and commons is where each owner pays taxes on their share of earnings, no automatic transfer at death, and assets pass through probate. So each owner gets a step-up basis at death. Trusts. So for one error people make is spending the time to create a living trust and then not titling assets in its name, keeping the trust essentially empty and preventing it from serving the goal it was created to serve. So assets registered in the name of the trust will be distributed upon the trust terms, not by way of will, and will avoid probate. So those beneficiary designations on retirement accounts and life insurance override the will. Taking a comprehensive approach ensures your wishes are honored and helps minimize legal or tax implications. Account titling determines who is taxed and how income is reported. It affects estate tax liability and step-up in basis rules. So certain structures can offer tax advantages or deferrals. So make beneficiary and account titling reviews a part of your financial wellness routine.
Excellent. Our
Back to
second
you, Eleanor.
resolution, great. Our second resolution is to create flexible liquidity. Cash and liquidity can charge a hidden premium through inflation and opportunity cost, but a lack of access to these can cause greater problems if you find yourself needing to draw from your investments at an inopportune time, as when the market is volatile or down. Finding about this balance in line with your life goals is important to avoid disrupting your long-term plan. At Carter Financial, many of us use the bucket approach to managing your cash flows. For example, we have a first bucket, which is 6 to 12 months of ready cash that sits in a money market or in a ladder of short-term CDs that continue rolling, and you use the cash as you need it, and then it gets replenished from your longer-term buckets of either fixed income or equity. The bucket 2 consists of longer-term fixed income products, and then the bucket 3 is your longest term products, which are equities, alternative investments, and the like. Other ways we can create liquidity include FDIC-insured savings, which are enhanced savings accounts. Raymond James has a multiple ways that we can help you get more liquidity with those. They can spread this out over numerous different banks, and this can help you make sure that all of your tranches of $250,000 can be insured at the FDIC minimum. We do this in tandem with your current bank that you bank at, so that we know that we don't put extra money into those banks, so that you are FDIC insured for all of your total cash everywhere. Securities-based lending is also an option. It's collateralized with the securities that you hold in your account, and the value of the underlying security falls. You may need to add more collateral, but you use your assets that you hold here to borrow against, so that you are not having to put up extra capital outside of the securities that you hold here. That's also a great way to use your own assets to borrow again. Structured lending is another collateralized debt product that can be built to suit your needs. Where SBLs are backed by securities, structured lending can be backed by nearly anything of monetary value with unique terms. Some people use coin collections, other people use very valuable pieces of art. Securities structured lending is something that you should discuss with your financial advisor should you need that way to create some flexible liquidity. Open lines of collateralized credit can be maintained at a low cost and be responsive to the ebbs and flows of timing in case you have a timing mismatch between when you have income coming in and when you need cash flow going out. I'm going to turn it back over to you, Deborah, for our next risk management.
Our next resolution is manage your risk. So it's good to consider protection against loss. I'm going to expand on this topic more than what is reflected on this slide because risk management goes beyond just insurance. It's a comprehensive strategy to really protect your financial goals and your legacy. You've worked so hard to build your wealth, and the last thing you want is unforeseen risk to derail your plans. So the key is identifying those blind spots and areas where you may be vulnerable. So some of the key areas to address include cybersecurity. So here it's like protect your assets, identity, and credit. Regularly update your passwords, ensuring they're complex and unique. Don't have your passwords in notes on your cell phone. Be vigilant about scams and fraud, especially those phishing emails and fraudulent calls. Many of you have been a target or have heard some horror stories about people losing thousands of dollars or having their identity stolen. It may be wise to consider freezing your credit and or signing up for identity theft protection service. Also, check your credit reports on a regular basis. Another area is property and asset protection. So to make sure you ensure adequate coverage, review your homeowner's insurance and compare it to the replacement cost of your home in case of a total loss from fire, tornado, or earthquakes. If you own valuable assets like vintage cars, art, or antiques, confirm that they are properly insured against specialized coverage. Documenting your assets is also really important in case you need to prepare for a claim. So in case of a theft or disaster, could you prove what you owned? What we recommend is actually to take your phone and video record each room and document your valuables. Just go around, just go to your rooms if you have some valuables or like silverware and drawers or so forth, jewelry. Take a video of that and then upload it to your cloud for easy access. Also, liability protection is to prepare for unexpected legal claims. Hopefully, a lot of these risk protection strategies are certainly all situations you hope never occur, but that's why we have these in place is to, in case you do get sued, that you consider having adequate umbrella insurance. And, or, for example, if someone slips and falls on your property or you're involved in a car accident, make sure you have enough liability coverage. So really review the liability coverage you have in your home and auto and your umbrella insurance policies. A few other areas include income protection to safeguard your family's financial security. So if you pass away prematurely, will your family have the resources to maintain their standard of living? If you became disabled and unable to work, do you have savings or disability insurance to cover your expenses? If you're a business owner, do you have the key person insurance for yourself or a key employee, such as other owners, executives, or top performers? You also need to consider planning for rising healthcare expenses as well as long-term care expenses. That high cost of long-term care can quickly deplete assets. We've seen this time and again. So please consider long-term care insurance to help cover, in-home healthcare, assisted living, skilled nursing facilities, and memory care for cognitive conditions. According to Genworth 2021 Cost of Care, the average cost of a nursing home care in a private room in Dallas was $9,244 per month, which is about $111,000 per year in 2024. And most healthcare plans and Medicare do not cover long-term care. Some other special considerations or unique risks include for if there's a chronic illness or dependent family member who may require additional planning. That's where, a special needs trust can provide financial security for a loved one who requires ongoing care. And also, Medicare supplement insurance can fill gaps in Medicare coverage. Risk management is a crucial component of financial planning. Reach out to your financial planner to help you identify those vulnerabilities and to also collaborate with your estate attorney, property and casualty insurance agent, and other professionals to build a solid protection strategy. Back to you, Eleanor.
Resolution to optimize your tax strategy. Tax policy, as we know, can move pretty quickly. So we need strategies to become more tax efficient, are not guaranteed to work one year to the next. Your financial advisor can work with your tax attorney to craft a holistic approach to suit your needs. It's all about keeping more of what you've earned. Make sure you're optimizing your 401k, especially if you have a matching situation with your employer. There's improving your portfolio's tax efficiency can include reviewing your annual turnover rate, tax loss harvesting at appropriate times during the year, especially if the market has taken a correction, as it has earlier this year, rebalancing in line with tax advantage securities, including direct indexing, capitalizing on business benefits, as I said, optimizing your 401k plan, maximizing your annual health savings account. Your HSA contributions can be rolled over year to year. They do not have to be spent in one calendar year. Supplemental employee retirement plans are a very good way to stash away some more money for the future. Also, if you have a charitable intent, develop a great charitable giving plan. You can start a charitable trust. You can put money into a donor advised fund. You can use endowments, and if you're very, very wealthy, you can set up a family foundation. These things as they're going from top to bottom, they get more and more complicated and therefore more and more expensive to facilitate, but your tax and your financial advisor can talk you through each of these things and see what's best for your family. If you place assets in an irrevocable trust, you remove the value of these assets from your estate. This is a great way, while the estate and gift tax exemptions are so high, currently $13.99 million per person, and with the political climate the way it is, we assume that those estate and gift tax provisions are going to continue past the end of 2025, but they still have not made those resolutions happen yet. So while those are still up high, if you have the inclination to get some of that out of your estate, you might want to talk with your tax attorney or a tax advisor and see if there's a way to create an irrevocable trust and remove some of that money from your estate. Then you can always give the gift tax minimum every year. You can always $19,000 is the annual gift exclusion this year. You can give $19,000 to any number of people, and that's a nice way of passing some money down to your heirs or to any other people that you seem charitably inclined to give money to. These strategies may be able to help you avoid some of the high income surcharges, such as the Medicare surtax and net investment income tax. And we're always trying to remember to keeping more of what you have and minimizing the amount that you have to pay in tax. So let's just try to keep that. Let's just try to keep the taxes to a minimum. Back to you, Deborah.
Okay. Next resolution is update your estate plan. So keeping your estate plan up to date ensures that your wishes are clear and that your loved ones are protected. Well, we've already touched on beneficiary designations and how property transfers at death. I think it's also essential to take a broader look at your estate plan. It's important to consider where you can avoid family conflicts. I think sibling rivalry, beneficiaries, differing financial positions, bitterness over caregiving, sentimental items, and lack of clarity can often cause family conflict over an estate. So communication can help assuage much of this. And where that fails, a solid plan and professional trustee to administer it may be helpful. And make sure your loved ones know where to find the relevant documents. Within an estate plan, state laws, not you, will determine what happens to your assets and who makes those decisions upon your behalf. So to avoid that uncertainty and potentially family disputes, consult an estate attorney to draft key documents, which include the will or trust, which specifies how your assets are distributed and who will oversee the process. A durable power of attorney, which is, where you name someone to handle financial matters if you become incapacitated. A medical power of attorney is assigning a trusted person to make healthcare decisions on your behalf. Guardianship designation specifies who will care for your minor children. An advance directive, also known as a directive physician, communicates your medical preferences in critical situations. So consider whether a trust is appropriate for your situation, and if so, who should serve as the successor trustee if you are unable to manage it yourself. Do you have a trusted family or friends that can serve as that successor trustee, or are you better off appointing a professional trustee or co-trustees? Don't forget your digital estate. With how much of our assets are now digital, it's also good to have a plan for your accounts. Many financial records, bills, and personal memories are all stored online. Think about how will your executor or trustee access your online banking, investments, and credit accounts? What should happen to your social media profiles and emails? How will family photos and videos be passed on? I think of the thousands and thousands of photos that I have that certainly I want to make sure get passed on to my children and hopefully their children too. Maybe not all of them, but certainly the good ones. Estate plans aren't set and forget. So review yours every 3 to 5 years or when major life events occur, such as a marriage or divorce, birth or adoption of children, starting, selling, or inheriting a business, or any other significant changes to your financial situation. The clearer and more up-to-date your estate plan is, I think the easier it'll be for your loved ones to carry out your final wishes without confusion or conflict. A well-prepared estate plan is one of the greatest gifts you can leave behind. Sorry, I realized I didn't change this slide, so there we go. Next resolution is updating gifting and wealth transfer strategies. So $73 trillion. That's the estimated amount of wealth expected to transfer to rising generations over the next 25 years. But the real question is, will your heirs be ready? Why wealth transfer planning matters. So a well-structured gifting and wealth transfer strategy ensures that your legacy is preserved, your values are carried forward, and your loved ones are financially prepared. Without proper planning, wealth can be eroded by taxes, mismanagement, or family disputes. So update your gifting and wealth transfer strategies. There are several options available for managing wealth transfer depending on your situation. Trust can be structured to meet individual needs with varying degrees of flexibility and tax efficiency. That annual gifting that Eleanor referred to, this is where you can take advantage of the IRS annual gift tax exclusion to transfer assets tax-free. So for 2025, the annual gift tax exclusion is $19,000, which means that a person can give up to $19,000 to as many people he or she wants without having to file a gift tax return, or have it reduce their lifetime estate and gift tax exemption. And if you wish to give more than that annual gift tax exclusion, consider paying tuition and medical expenses, if this is appropriate, directly to institutions to avoid gift tax implications. And it's important to be aware of those gifting limits, which can change from year to year. So maximize the use of the estate and gift tax exemption while it remains historically high. And the exclusion this year is $13,990,000 this year. Another strategy is charitable giving, which again, Eleanor has touched on, but we'll certainly expand on shortly. And then we also have private placement life insurance, which can provide a tax advantage over other forms of inheritance. So review those gifting and wealth transfer strategies regularly with your financial planner, estate attorney, and tax advisor to assure it aligns with your goals, tax laws, and evolving family needs. I think a proactive approach today ensures a smooth and meaningful wealth transition for future generations. Eleanor.
As Deborah mentioned, planning a powerful philanthropic legacy is our next resolution. There are more options than ever to build a gifting strategy in line with how and when and to whom you want to give. You can have donor advised funds are becoming more and more popular. If you'll go to the next slide, please. Yes. Donor advised funds are becoming more popular as they offer a lot of flexibility with a tax strategy with some limitations on who can receive grants. In a donor advised fund, if you happen to have a large windfall in 1 year, say a large bonus at your job, or you get a big inheritance or something, you can put chunk of money into a donor advised fund in 1 year, takes the tax deduction, and then you are allowed to gift that money out over subsequent years to the charities of your choice. These donor advised funds can be held at Raymond James. They can be held at communities foundations in the cities where you live. They can be held at foundations that are at charities that are important to you. Sometimes they're religious charities. Sometimes they are charities that are allied with some other value of yours. For example, in Dallas, we have many different charities that can support donor advised funds. They will vet the charities that you want to give your money to. Make sure they're a 501c3 fund. Make sure that you are gifting to reliable and reputable charities, and then they give you the option of giving anonymously. So, for example, if you don't want to be hit up by every charity that's out there and put your name out there, you can give through your donor advised fund and mark it as anonymous so that you can support a charity and make a donation to help people, but you can give it under an anonymous charity that it will come straight from that, say the Communities Foundation or the Texas Women's Foundation or some other situation like that, where you don't have to have your name on the charity per se. If philanthropy is a major part of your day-to-day life and you have much to give, I mentioned before a private foundation. Private foundations are quite expensive to set up, and you have to have somebody on it all the time. So you're probably going to have to hire someone to work on that for you, because they are going to have to do all that vetting that that a charitable situation does for you. Somebody who runs donor advised fund has a whole group of people that does all that vetting for you. If you have your own private foundation and this is a major part of your life, you are going to have to hire someone to do that vetting for you. Charitable trusts come in a number of options. You have charitable remainder trusts, you have charitable lead trusts. If you have interest in these types of situations, talk to your financial advisor. They are very willing to get together with you and your tax attorney and set up a trust like this, whereby the charity can either get a stream of payments and then you get the money at the end, or you get a stream of payments and the charity gets the money at the end. There are many, many ways to be philanthropic. And the nice part about it is you can give low cost basis stock, which are worth more to a charity than they are to you because of capital gains tax. So if you're ever faced with a giant capital gains situation and you're thinking of giving a gift, give that stock first because you can give that low basis stock directly to the charity. Don't sell it for pity's sakes. Give it directly to the charity. They take the stock at the value that it is on your statement. They don't have to pay that capital gains tax. You get credit for that whole gift at whatever the market price is now, and they don't have to pay that capital gain. So that is a win-win for everybody involved. Also, consider qualified charitable distributions from your IRAs. It's a terrific way to gift directly to a charity. You do not pay the tax on your IRA distribution that you would typically pay when you're pulling your money out at the of your IRA that you've put in as pre-tax money all these years. If you have a charitable inclination, you can pull that money out, give it directly from your IRA to the charity. Don't give it to yourself first, or you'll have to pay tax on it. Give it directly to the charity, and they will get that full amount of distribution without your having to pay your income tax on it. So these are just little tidbits that we can help you with at Carter Financial. Figure out how to make the most bang for your charitable buck. Okay, Deborah, off to you.
One thing I was going to add to that too, Eleanor, with
Yeah.
the qualified charitable distributions, which we abbreviate as QCDs, I mean, they're such a great tool, but you do have to be 70 and a half before you can do a QCD. So just
very good
need to
point.
keep
Yes.
that in mind. Yeah.
You youngsters, no can do, youngsters. No can do.
Okay. Our next resolution is have a family conversation. So sustaining the benefits of wealth for generations is difficult and nearly impossible without mutual understanding among family members. Not many families sit around the dinner table talking about money, but as we get older and we can settle a lot of the anxieties held by our spouses or families by being clear. So also discuss non-financial topics too, like your values, expectations, and important life lessons. Ensure it's age appropriate and the right stakeholders have the information they need to be good stewards. So what are the 5 ways to avoid the most common reasons wealth transfers fail? The first one is create a shared vision. Define what your wealth is meant to accomplish. Is it about financial security, philanthropy, supporting future generations? Discuss those long-term goals for the family, including business succession, the charitable giving, or multi-generational planning. Impart your family values. So what principles have guided your financial decisions? What lessons about work, ethic, generosity, and financial responsibility do you want to pass down? So consider documenting your family's missions and values as a guiding philosophy. And then have those meaningful communication and conversations. These regular family meetings create an open space for discussions about wealth, inheritance, and financial planning. And invite professional advisors, such as your financial planner, estate attorneys, or CPAs, to provide education and facilitate discussions. You know, we certainly do that here at Carter Financial. Foster transparency and trust. So many families avoid financial discussions out of fear of conflict or entitlement. But secrecy often leads to more misunderstanding and disputes. So be clear about those roles and responsibilities. Who will manage assets, serve as trustees, or oversee family business interests? Ensure everyone understands the estate plan, trusts, and financial structures in place. And then promote gratitude, not entitlement. Encourage your younger generations to see wealth as an opportunity, not a guarantee. Instill a strong work ethic and sense of purpose in heirs, and consider philanthropic activities that involve the whole family, sort of reinforcing that idea of giving back and responsible wealth management. And take action. So schedule a family wealth conversation this year, even if it's just a first step. So think about, you know, when's the next time you think you may be together, whether it's Memorial or July 4th or, you know, or a family reunion, and just find a time that works for you. Use this time to listen, educate, and align on key financial matters, and work with your financial planner or estate attorney to create a roadmap that ensures clarity and long-term success. I would end with, like, a well-structured family dialogue today can certainly help preserve those financial assets and family harmony for generations to come. Eleanor.
Okay, digitalizing your record keeping. So this is a resolution that's a little harder for somebody with my color hair. We accounts with different companies. We have emails, we have physical mails, we have updated schedules, we have everything. It can be a lot. Digitalizing your record keeping can make things more manageable. If you have a plan with Carter Advisory Services, you know that you have your private vault in which you can store many of your important records, such as Deborah mentioned earlier about taking a video of all your jewelry or all your artwork and things like that, and uploading it into your private vault. In case of an actual emergency, it can be stored in that vault off-site so that, God forbid, anything like the Palisades fires happen and things are destroyed, you can have a record of that, of your valuable holdings somewhere in the cloud. You can also store your tax returns, your wills, your ancillary documents that Deborah mentioned, your insurance purchases, your insurance policies, other very important documents that someone might need in the event of your disability or your demise. All of these things can be stored in your private vault, and then all your heirs or the person who you've given the password to can get into your vault and find these records, and they won't have to be searching all over your house trying to figure out where your red box is with all your important papers in it. You're likely to have many accounts where you receive all of these updates. I know I have a couple of email accounts where I receive different things. Some are personal, some are for business. Centralize your important documents, reports, and forms in one place can save a lot of frustration, and it makes it easier for things to look at as a whole. As you get closer and closer to retirement, or as you get closer and closer, if you think that something's happening to a family member, consolidate all these things. Make sure that everything can be found in one place. You can, another option is an Everplans plan. You can look at that through Raymond James. Contact your financial advisor to see if that's something that can be useful for you and your family. It does more than just file storage. And despite high-profile institutional security failures and data breaches, basic security measures like Deborah discussed earlier, having your passwords changed quickly and accurately, making them unique and unguessable, make it very unlikely that personal data and storage will be compromised. So you have to be rigorous about it. You just can't use your dog's name and your mother's maiden name. That's really easily figure outable. So please just make sure that you're using unique things and long passwords, but just get rid of all that clutter. Make sure you have a good shredder. Thank you, Lori, for Shred Day. And I'm going to turn it back over to you, Deborah, to get on with our next topic.
Our next resolution is explore alternative investments. And alternative investments are really essentially any investment outside traditional financial securities. So like art, for example, can be an alternative investment. But mostly when we're talking about alts, we're talking about the 5 categories listed here. There's, hedge funds, private equity deals, managed futures, real estate, and commodities. These objects tend to have a little bit more tangible value. Sorry. I went a little too far. Let me go back. There we go. Okay. So why consider alternative investments? So the case is that one thing to consider is they have lower correlation to traditional markets. So one of the key advantages of alternative investments is their ability to perform independently of the broader economy. Unlike stocks and bonds, alternatives often move on their own cycles. For example, when the S&P 500 declines, certain alternative assets may still appreciate. This ability to hedge against market trends is what gives some of the most well-known alternatives, such as hedge funds, their name. Increased allocation among high net worth investors. So as wealth increases, portfolios tend to allocate a greater percentage to alternative investments. This shift really reflects both the desire for higher potential returns and the need for broader diversification beyond traditional asset classes. Now, keep in mind, it can be higher risk and there's liquidity considerations. So alternative investments are often perceived as riskier and less liquid than traditional assets. And because of this, many require investors to meet certain minimum income and net worth thresholds. These barriers to entry ensure that participants can withstand the potential risk and longer investment horizons associated with alternatives. But some of the key benefits of alternative investments include potential for higher returns, income generation, diversification and lower correlation, and inflation protection. Now, there's certainly, as I said, there's a variety out there, and they all tend to have slightly different objectives. But by incorporating alternatives into a well-structured portfolio, investors can access unique return streams, reduce market dependence, and enhance long-term financial resilience. So a bold step into this year is managing significant wealth is an endeavor that demands expertise, the right implements, attention to detail, and a broad perspective. You know, we have covered several financial resolutions, from reviewing your beneficiaries and estate plan, creating flexible credit, managing risk, optimizing tax strategies and charitable giving, and having family conversation, just to name a few. And there certainly are a few other important ones that we didn't get into a lot of detail. So including, I know Eleanor touched on this, but make sure you check your retirement progress and revisit your asset allocation and rebalance your portfolio at least annually with your financial advisor. And reassess your risk tolerance every few years or as your circumstances change. So prioritize these financial resolutions where you most need to focus and develop a plan to tackle maybe one area each month. The purpose really here is not to overwhelm you with 100 things to do, but to help you identify those opportunities and blind spots and help you work towards your goals. We at Carter Financial Management are really grateful for the opportunity to help you plan your future, pursue your goals, and create a legacy built to last. So please reach out to your financial advisor if you need help and guidance on tackling any of these financial resolutions. And as a reminder, if you have any questions, yes, please type them into the chat box or reach out to your financial advisor. Thank you for your continued trust.
Thanks, everybody.
Thanks so much for joining us today.
Happy New Year.